Have you often wondered, what in the world does short selling mean? And why are we hearing about that in the news these days? Well, if that's of interest to you, stay tuned. I have some answers for you. Before I start on this video, I want to remind you that I have a free workshop that is available to you by clicking on the link in the description box below this video. It's about 90 minutes long. I'm not trying to sell you anything. I'm just trying to offer you some insight and different ways that I think, and to help you possibly think in different ways yourself. The coverage includes a lot of different areas. Of course, I talk about the financial markets in general and a little bit about the stock market itself. I also cover sports. I'm a big fan of sports. Music. I've been playing music since I was very young. And I also talk about professional and personal relationships. The goal of this workshop is to help you to think in either new or different ways, as well as for you to get to know me and my style. I want to take just a second to explain my approach to this section. To help you understand the concepts that I present, I will provide concepts and definitions throughout this entire section to help you understand things that way, but I'm also going to provide a number of examples and 3 specific kinds of examples because different people learn and understand things in slightly different ways. The first one is just to give you a verbal example. I'll just sit here and tell you an example that I have, and for some of you, that'll be fine. You'll be able to understand things just fine that way. The second example will be verbally with some text. I will also tell you this example, but I'll provide text on the screen for you to look at the same time. And then the last example is I will go through verbally once more, but I'll have some very simple graphics. And my hope is that one of those ways or a combination of those ways help you to understand what I'm talking about in this section. So understanding long and short. There are 2 types of transactions that take place in the stock market. We can buy and we can sell. That is not all that complicated right there. If you're looking to get into a stock, you buy first, and then at some point in the future, you look to sell. So if an investor wants to buy low and sell high, you want to buy something at 10 and sell it at 15 in the future, then that investor is long. You bought to start this whole process, and you will sell to end this process. If an investor wants to sell high and buy low, which probably doesn't make a lot of sense to some of you, then that investor is short. And I can think of all the questions that you're coming up with right now. You sell first? How does that work? That's what I'm going to take a lot of effort to explain in this section. Let's look at the concept of long. Most investors understand that. I'm going long. I want to buy at 50 and sell at 100. Basically, an investment is purchased at a specific price with the hope that over time, and this could be a few days, weeks, months, years, decades, generations, that the price that you bought it at will increase. If you bought it at 10, you're looking at that point forward for the price to increase in value. So at a later point, the investment can be sold for a profit or a loss. When you complete both sides of the transaction, you have a buy to get in and a sell to get out, and everything is done. That is called a realized profit or loss. Another alternative would be to continue to hold on to that investment, hoping that the value will increase even more. So let's say you get in at 10, it goes to 15, just like you wanted it to, but you look at it and go, the chart's looking pretty good. The news about this company is pretty positive. I think I'm going to hold on to this a little bit longer. Now, you still have a 5-point profit, but you haven't completed the other side of the transaction yet. So that is considered to be an unrealized profit. The idea is to buy low and sell high for a profit, and we're all happy when we can do that. And we also sometimes buy high and sell low for a loss. And most people don't find that really challenging to understand. Now we get into an area that is a bit more complicated for people to understand because we're using terms that are used in slightly different ways than how we use them every day. Many investors don't even realize that it's possible to go short. You can sell something first and then buy it back later. This can often be very difficult to understand, and I'm not joking about this. One time, I literally had an 8-hour conversation with a person trying to have them understand the concept of short. I was working at a job and we were working together that day, and we got into a conversation, and as we were going through our duties for that day, we kept having this conversation, and it just did not click with this person until the very end. They finally had an aha moment where it's like, okay, now I get it. The angels are singing. The sun is coming through the clouds. Everything is wonderful. It has to click with most people. The basic concept is to look at this in terms of it being part of a transaction. We just use the term buy and we use the term sell. In this sense, you sell an investment first. Yes, you are selling something you don't own. This is the question I get most of the time, and I've got it I don't know how many times. How can you sell something you don't own? I'm going to show you how you can do that in this section. The idea then is to sell it first and then replace that investment at a lower price in the future. Here's the verbal example. I'm just going to use an example of the Boeing company because I'm from Seattle and they build airplanes. So I'm just going to give you a verbal example of how that works. Let's say that Boeing decides to build a new airplane. What do they have to do? They have to go out and buy the materials for that new airplane. They have to hire the people to build that airplane. They have to design and test that airplane. That costs a lot of money. They're buying all of that first. And then at some point, they have an airplane built and they make a big deal out of it and it flies around and everybody loves it. All the airlines are there watching. And so they decide to put this airplane on the market and other airlines like that. So they come in and they buy airplanes from Boeing, or Boeing sells airplanes to the airlines. What they did is they went long first. They bought everything they needed to create that airplane. And then once that airplane is built, they sold it to a customer. That is going long. Let's look at it in a little different way, but very simplistic. It's more complicated than this. I just want you to understand the concept. Does Boeing always build all the airplanes first before they sell them? No. They have some airplanes available. The customers know what these airplanes can do and what they're like, but they don't physically have them. But they go out to the airlines and they'll sell something they don't own to an airline. They sold first. Then, keeping this simple, let's say they take the money that they got from the airline, they go out and they use that money to buy what they need for that airplane, to pay the people who are going to build that airplane. And what they did, they received a certain amount of money, and what it cost Boeing to build that airplane was less. So they sold something for, let's say, $10 million. I know that's not the right price, but it cost them $8 million to use that $10 million to build that airplane. They now have a $2 million profit. They sold first, and then they bought everything they needed last. Those are different parts of a transaction. So in the first instance, they bought everything first and then sold it. In the second instance, they sold it first and then bought what they needed second. And the difference between the two is the profit or the loss. Now I'll go through a different example, but I'll have some text on the screen that you can actually follow as I go through this. When people go long, that's pretty understandable. Buy low, sell high. Selling short can be confusing and require an aha moment. And I hope some of you have already had that moment, or you're getting that moment as you're going through this section. Let me give you an example. You want to make some money. Isn't that why we do this? Isn't that why we're in the stock market? We want to make money. And do we really care if we buy first and sell second? Or if we sell first and buy second? No. The idea is we want to earn a profit. You think you can make some money by selling Superbowl tickets to someone else. Let's say you have a friend. They're very busy or they're very lazy. They want to go to the Super Bowl, but they don't have the time or the desire to go down and buy the tickets for themselves. So you think, maybe there's a little way I can make some money here. Here's the long example. What you do is you go down to the ticket office and you buy a ticket for $800. You might buy 4 tickets, but I'm just going to use 1 ticket in the example. and then you sell them to your friend for $1,000. You put out $800, you go to your friend gives you $1,000. After everything is finished, you have made a $200 profit on that ticket. You went long. You bought first and sold second. Here's a short example. Let's say you don't have any money, but you sell the tickets for $1,000 each. You go to your friend and say, hey, I can get you Super Bowl tickets for $1,000 each. So your friend gives you the $1,000. You then take that $1,000 down to the ticket office and you use that to buy the tickets for $800 each. You have made a profit of $200 on that ticket. You sold something that you don't even own. You received the $1,000, then you went down and you bought the tickets. The difference between the two is your profit, and in this case, it's $200. That is a short example. The next example that I'm going to go through, it has some pretty silly graphics. I'm not really good with this. I did these graphics with PowerPoint, so we'll see if this looks okay. Here, we'll go through a long example, and I have two examples. This is the first one. You decide that you want to buy a share of Disney stock. You like the Disney company and you want to be an investor in that company. So the first thing that you do is you buy to enter. And let's say the price is $10 for that one share. Now the price of Disney is way different than that. This is just to illustrate a point. Then at some point in the future, it might be a few days, weeks, months, decades, generations later, you want to sell that share of stock to exit. So now both sides of the transaction are completed. And when you sold that one share of stock, it was at $15. So we compare the price that you got in, $10, with the price that you received when you got out, and that's $15. So we take the sell price and subtract the buy price, and we realize, whoa, we have a profit, a $5 profit on a $10 investment. That's a 50% return. We take the $15 that we received when we sold, we subtract the $10 that it cost us when we bought, and that gives us a $5 profit. Woohoo! Here's another example of going long. Again, you decide you want to buy some of the Disney company. The first step is you buy to enter, just like in the other example, and it's at $15 a share. You decided to wait a little while on this one, and then at some point in the future, you want to sell to exit, to close out that transaction. The problem is now it's at $10 per share. We compare the buy price with the sell price. So we take the sell price and we subtract the buy price, and we realize there is a loss in this transaction. We sold it at 10 after we bought it at 15, and that results in a $5 loss. So I gave you one example of going long where you have a profit, and another example of when you went long, but you had a loss. Now let's go in the other direction. Let's go short here. Again, we're still dealing with the Disney company. The first step is that you want to sell to enter. Yes, you sell first. And when you do that, the price is $15 for that share. Then at some point in the future, you have to buy to exit. And at that point, it is at $10. So Disney stock did go down. You sold at 15, and now you can buy it back at 10. We compare the sell price with the buy price. We take the sell price and subtract the buy price, and we see that we have a profit. Number terms, we sold at 15, we bought it back at 10, and that gives us a $5 profit. Now, the last example here, short example number 2, again, with the Disney company. The first step is you sell to enter. So you're starting off by selling, and it's at $10. Then at some point in the future, you want to buy to exit. But when you do that, it's at $15. Instead of going down, Disney stock went up. We compare the two with each other, and we take the sell price and we subtract the buy price, and we notice that we have a loss. And that results in a $5 loss. Instead of going down, the stock went up. So my hope is that through these different examples, some of this clicked for you. Not only do I want to teach you this concept, even if you never take any of my other courses, I need people to understand this when they come into my other courses because I can't take the time to do this. We have so much to cover in my other classes. I need people to already understand this when they're coming through the door. So what can go wrong when you are a short seller? There are lots of things that can go wrong. Short selling may sound great as long as everything goes as expected. If you are net short in the market and the market is tanking, you're pretty happy at that point because you're making a profit, while other people may see their profits starting to evaporate, if not experience losses. If things go wrong and you sold the market short, the pain can be very extreme. Think about this. If you buy a stock at 10, how low can it go? It can only go to 0. But if you sell a stock at 10, hoping that it will go down, how high can it go? There's no limit. Nobody's ever experienced that before. There have been a lot of $300, $500, $3,000 stocks now that at one point were at $10 a share. When a short seller starts to experience a loss, it's required to take action much quicker. Now, a lot of us take the old buy and hold approach or buy it and forget it approach. If you're a short seller, you can't do that. You need to really pay attention to what's going on, because this changes all the time and there's a lot more stringent rules when you short sell, and you can't just forget about it. You have to keep on top of this. There are laws in place that you have to follow, and your broker may have additional laws that you also have to follow. If a stock that is expected to fall starts to climb, a short seller must cover. That's when they're getting out and either experiencing less of a profit, if not a loss, and they have to exit that position. They don't have a choice. Where if you buy a stock at 10 and it goes down to 1 or 2 and you didn't buy that on margin, you can hold on to it. You can even let it go to 0. But if a short seller starts to experience a loss, there are times when they have to get out. There's a thing called a margin call. And if they get to that level, they don't have a choice. They have to exit. This means that they must buy to close the position. So sometimes the decision is made for you. So short selling can be nice when you're right, but if you're wrong, you may get to the point where you're not making decisions anymore. The market is making the decisions for you. When a stock starts to run away to the upside, forcing short sellers to cover, this can be known as a short cover rally. If you've seen on days when the market's going up and up and up and it just seems to never stop and it's going higher and higher, a lot of that is a short cover rally or a short squeeze, because that's the short positions having to buy to exit, and that forces prices even higher. There are a lot of people that really hate short sellers. They think, these are bad, evil, terrible, awful people. Few reasons why people don't like short selling. Number one, it's harder to understand. If your attitude is, how can you sell something you don't own, and you stay right at that point, you're not going to understand short selling. So a lot of people don't do what they don't understand, which to me doesn't make a lot of sense, because people jump into the stock market and do things they don't understand all the time. The financial requirements, if you want to go short, are massive. You have to have a lot of money upfront and in your account to cover any potential losses. Is that really good for you? Because that money that you have to keep in your account, maybe that could be used elsewhere where you're actually making profits. You can lose more than your investment. If you buy a $10 stock and it goes to 0, that's as far as it can go. But if you short sell a stock at 10 and it goes to 1,000, you have a massive loss on your hands, and you lost more than you were going to get from a profit. Another reason why people don't like short sellers is you might consider this to be unpatriotic. Man, we want to invest in companies that are going to go up. And if they make a profit, that's great, and we get to enjoy that. But if they're going down, we shouldn't take advantage of that. That's not the American way of doing things. We don't feel that's right. That's unethical to do that. Some people don't have a problem with that. They realize that markets go up and markets go down. To take advantage of that is not only patriotic, it's also very ethical and part of the process that we go through. You have to decide where you come out in that argument. You might think that short sellers are the ones who drive the stock market down, and that's just not true. They're short well before prices really start to fall, but when they get in, they might be having a bit of an influence on prices going lower, but when they get out, they have to buy. If anything, they add some support to the market. So when the markets are really tanking and you hear people in the government or people in the media saying, oh, these traders are doing this, they're doing that, they're shorting the market, they're evil, they're bad. Don't believe that. That's not how it works. There's just an awful lot of selling going on, and most of those people that are selling are long positions. They just can't take it anymore, so they get out. They're the ones that are really pushing prices lower because there's so many more people that go long than go short in the market. One thing that I like to point out in this section that you may not be aware of is we get a cliche from this. Don't sell yourself short. When you talk about yourself and you don't think you're as good as you are, you talk yourself down. We use the cliche, don't sell yourself short, from this method of investing. And I put investing in quotes because it's not real investing. This isn't something that you do for long periods of time. When you short sell, it's usually for shorter periods of time. So let's go through some more understanding of short selling. We'll go back to our Super Bowl ticket example. You don't have any money with you right now, but you can sell the tickets for $1,000 each. That money can be used to buy the tickets for $800. You've made a profit of $200 on each ticket. What if something goes wrong in that scenario? You get the money from your friend, the $1,000 for that one ticket, and instead of the Super Bowl tickets costing $800 when you get to the ticket office, your heart sinks when you realize the lowest price now is $1,200. Something happened during that period of time, and the price of those Super Bowl tickets went up. You received $1,000 from your friend, but now you're going to have to buy them for $1,200. So now you have made a loss of $200 on each ticket. Is there any limit to how high those ticket prices can go? No, there isn't. If it's a really popular game, what if the price goes to $2,000? You got the $1,000 from your friend, but now you have to pay an additional $1,000. You see how this can spiral out of control? What if it goes to $3,000? There is no limit. As long as somebody is willing to pay a particular price, that price is the right price. It may not be the correct price, but it is the right price. It's the market price at that time. So things can go against you very severely when you short sell. Your clever idea in this case has backfired. What is an alternative to this? Why am I taking any time to even explain shorting to you? If you've watched many of my videos, I say that there are opportunities to make money when the market goes up, sideways, or down. Well, how do we take advantage of things going down if short selling can be so dangerous? Well, we have a thing called inverse positions. The SPX investing program, which is a program that I teach, does not endorse short selling in the absolute sense. The way I explained it here, I would not recommend that anybody do it that way. There are people that do, and if you already do that, you're probably not listening to this video because you already know what you're doing. But when you're new at this and you want to take advantage of the markets declining, there are better alternatives for you. There are strategies that can be implemented using mutual funds and ETFs that go up in value when the S&P 500 goes down. And that's one of the reasons why I use the S&P 500. These inverse positions have a lot more volume. They're a lot more popular. Now, there are inverse positions on the Dow and the NASDAQ 100, and some of those are very popular. But I have settled on using the S&P 500. What you learn here, you can easily transfer over into other indexes. It's important to understand the concept of short selling, but it is less complicated to take advantage of a mutual fund, an inverse mutual fund, which goes up in value if the market goes down, or an ETF, does the same thing, that is positioned to gain in value if the S&P 500 goes down. So what we do is we buy into these positions, and if the market does go down, we make a profit, and when we're done with that, we sell to get out of that position. To make it really, really weird, you are going long a short position because the instruments inside of these mutual funds and ETFs, they're already designed to go up in value if the market goes down. So you buy to get in and you sell to get out. This, in my opinion, is much safer. It's not risk-free. You can still be wrong and lose money. But the vehicles that we're using and the approach and the concept of what we're doing is the same and is less risky than just flat out short selling. What I'm going to do next is shift gears a little bit and look at how can we use what's called short interest to our advantage. How much of a stock is shorted in a company or an index? Can we use that information? And can that give us any insight? When looking at an investment, it can be wise to look at the short interest ratio, also simply called the short ratio. How much of that stock is shorted? Some of this information is delayed. Some of it is a little bit hard to find, but there is information out there. Typically, this is measured in a thing called days to cover. If you took all of the shorted stock out there and no other transactions took place, there was just buying that was going on, how many days would it take for all of those shorted shares to leave the market or to be closed out or for the transactions to be completed? Days to cover measures the expected number of days to close out all short positions in a stock or in an index. This is where it's critical, and this is how we can use this to our advantage. The higher the number or the ratio, the more built-in buyers there are on the sidelines. What do short sellers have to do to get out? They have to buy, which pushes prices even higher. If you have a high short interest in a stock or an index, and we really start going up, those shorts are losing money, and they're going to have to get out. And they're going to have to buy to get out, which could push prices even higher. They have to watch these things really close, and if prices move against them, they have to get out. They must come in and buy or cover their short positions if prices go against them. So we like this when there's a high short interest ratio. I keep an eye on that. I talk about that in my daily and weekly videos that I do. You can look at that for individual stocks. And you want to keep that in mind when you're getting into an investment, especially if you're long. When they must act, meaning the short sellers, this can cause a short squeeze, which can see prices soar higher and higher and higher, or you see a buying frenzy going on. It's like, why are prices just skyrocketing up? A lot of times it's the shorts having to cover, because they're losing money, because their requirements are more stringent and they have to get out. They don't have a choice. They can't just wait for tomorrow or wait for next week. They need to act right now. This is what happened to some hedge funds, and I talk about hedge funds later. But in the early part of 2021, some of you may have heard of the GameStop situation, where there were a lot of people that got together and started to pump up the price of GameStop. Well, a lot of hedge funds had shorted that stock, and they're seeing real losses because of that, and they had to go in and cover, and that pushed prices higher and higher and higher. Then I want to finish off this section by talking about unrealized profits or losses. Unrealized profits can be beneficial to you. So you bought a stock at 10, it's currently at 15, but you haven't sold it yet? Well, this can be considered an asset on your personal or business balance sheet. This has value attached to it. Now, it changes all the time. It goes up and down every day with the market, but you can use this as part of your overall net worth. It also can be used as collateral for a loan, where you can borrow against shares that maybe you haven't sold yet, but you're showing a nice profit on. You can also use that to buy more stock, or you can borrow against that for a different purpose. How can an unrealized loss be beneficial? It's common to sell investments that are showing a loss to help offset profits. This helps to reduce tax liabilities. Now, it's not necessarily in our favor to do this, where we have to pay all of the gains and we only get to show part of the losses, but still, this can help your overall tax situation. We're getting near the end of the year. It's December. That is the end of the calendar year and the end of your personal fiscal year. And you have some stocks that are showing a loss. You may decide in December to sell off those stocks because you had some really nice gains in other stocks. And so you can offset some of that so that your overall tax bill is less. Then I'll finish out by talking about the holding period, and I do mention this in other videos, but under current tax laws, how long you hold on to an investment, either long or short, will determine how taxes are applied to you. If it's longer than 1 year plus 1 day, that is a long-term capital gain or loss, and that currently is taxed at a different rate than the next one that I'm going to show you, which is something that you hold on to for less than 1 year. This is a short-term capital gain or loss. This is where we make that line between investor, longer than 1 year, and trader, shorter than 1 year, and you may be a combination of the two. This needs to be rechecked often since IRS laws are changing all the time. We have a new administration and there are massive changes going on. And there's going to be additional changes that will impact each person. And so this might change. So thank you very much for watching this video. I appreciate it. And please feel free to subscribe to this channel and leave a comment. And don't forget, there are other videos right here that you can watch for more useful information about the stock market.